So, it is now my pleasure to introduce Jay Rosenzweig to lead our next session on the topic of how to identify talent and introduce our next speaker. Just by way of context, Jay is the founding partner of Rosenzweig and Company, which has become a global leader in executive search and leadership development. And Jay advises a wide array of small, private, large public, and some of the largest corporations in the world. As such, he is no stranger to identifying talent, and it gives me great privilege and pleasure to welcome my friend Jay Rosenzweig to the stage.
Y'all ready for this? Thank you, Mo. Good morning, everyone. One of the real pleasures of working in the field of talent acquisition is you get to meet a lot of very interesting people and engage them in conversation. Our guest speaker, William Thorndike, is just such a person. Will has an astonishingly wide range of interests and affiliations. A graduate of Harvard College and Stanford's Graduate School of Business. In 1994, he founded Housatonic Partners in Boston, a successful private equity investment firm that is focused on very specific sectors, including recurring services, media, and the communications industry. Will sits on a number of boards. He's the director of Alta Colleges, Carillon Assisted Living, Liberty Towers, Oasis Group, QMC International, White Flower Farm, is a trustee of the Stanford Business School Trust, and is a founding partner at FARM, a social impact investing fund collaboration. And that's just to name a few. But Will is undoubtedly best known as the author of the best-selling book, The Outsiders, which examines 8 unconventional but highly successful CEOs. This well-researched book, Will and his team conducted more than 100 interviews and studied more than 1,000 company years of financial data, has become a must-read not only for investors, but for those interested in leadership. So Will, welcome to Toronto. How are you? Good to see you.
It's appropriate music.
I'd like to start by asking you a question I would normally use with a prospective CEO candidate. Please tell me a little bit about yourself beyond your resume, perhaps who most influenced you growing up, or thinking beyond business and family, the things that you are most passionate about.
Wow, that's an interesting question to start things off. Let's see. So, I think I've had a range of influences across my life. I went to business school at Stanford, as you said, and was exposed there to a couple of professors who had a profound impact on me. When I went to Stanford, Jim Collins, who has since become a writer and consultant and speaker, was a member of the faculty there and was an influence on me. And another influence was a professor there named Irv Grossbeck, who had founded and grown a very substantial cable television business in the United States called Continental Cablevision, and had then devoted sort of the balance of his career to teaching and thinking at Stanford. So he was an important influence as well.
So what in essence did you learn from these mentors?
So just I think the importance of continually learning, wanting to sort of continue. In this book project, I'm not an author. It grew out of a talk that I gave at a CEO conference that my firm hosts every other year for our portfolio company CEOs. And it was sort of an organic process of researching a single CEO for that first talk, and then that grew into another, working with a very talented group of Harvard Business School MBAs, another chapter. And so I think the real lesson from them is the value, particularly as an investor, of, trying to continually learn and stretch yourself. The idea, that Charlie Munger talks about evolving to become a learning machine, and I think those two professors exemplified that.
Great. Well, why don't we turn to the book, The Outsiders? I've had a chance to read it, and I certainly understand why it's resonated with so many people. But if you had to describe the book in just a few words, what would you say?
Yeah, so I think, how many of you play bridge? How many bridge players in the audience? Okay, so that's a relatively low penetration. So I think the best analogy for the book is duplicate bridge. Okay, so duplicate bridge is an advanced form of bridge in which a group of teams of 2 show up in a room. They're divided into tables of 4, each of which is then dealt the exact same cards in the exact same sequence. The idea being to minimize the role of luck. And at the end of the evening, the team with the most points wins. So it's designed to be a pretty pure test of skill. And I would contend that over longer periods of time, within an industry, say 20 years, which is the average tenure of the CEOs profiled in the book, it's duplicate bridge. So if one company materially outperforms the peer group, that's worthy of study. And so the 8 CEOs in this book, 7 men, 1 woman, had to meet 2 tests. They had to have better performance relative to the S&P 500 than Jack Welch had during his 20-year tenure at GE. That's sort of the absolute test. And then they had to dramatically outperform the peer group. And on average, they outperformed the S&P by 20-fold, and they outperformed their peer group by 7-fold. And so, by definition, in order to achieve that sort of outperformance, they needed to be doing things differently than their peers. But it turned out that the specific actions they were taking, the things they were doing, were remarkably similar across the group. So they competed in a wide variety of industries, so ranging from manufacturing to defense, financial services, consumer products, media, and across a range of market conditions. But the specific actions they took were very similar, and the primary area of overlap was in the area of capital allocation. A topic that many in this room are intimately familiar with. And I think the best way to think about capital allocation is that for a CEO to be successful in the longer term, they need to do 2 things well. They need to optimize the business, the profits of the business that they're running. They then need to invest or allocate those profits. And over long periods of time, that second activity, capital allocation, has a disproportionate impact on per share outcomes for shareholders. And the framework there is, for any business, there are only 3 ways that you can raise capital. You can tap your cash flow, you can issue debt, or you can raise equity. That's it. And then there are only 5 things that you can do with that capital. You can invest in your existing operations, you can buy another company, you can pay a dividend, you can pay down debt, and you can repurchase your stock. That's it. And over long periods of time, the decisions CEOs make across those various alternatives have an enormous impact on shareholder outcomes. So 2 businesses that had the same level of revenue and profitability, but different approaches to capital allocation, would derive 2 very different share price outcomes for their shareholders over the long term.
So I can attest, just given what I do, to the fact that assessing leadership is a highly complicated matter. So it seems, based on your premise and talking about Jack Welch, who certainly was a great leader in his own right, that there's sometimes a bit of a misperception when looking at leaders. If there was, let's say, a tailwind from a market conditions point of view. So sometimes the kind of analysis of a leader can be superficial based on some wins that might have been in their favor. Is that something that you talk about?
Yeah, no, exactly right, Jay. So I think that's why it's critical to compare any CEO's record to the overall market performance relative to the S&P, which is that first test, and then critically importantly to their peer group. So that you're comparing them to people who are facing the same circumstances within the given industry. And I would say the other piece that's sort of interesting is, to your point about, attracting talent or thinking about the sort of personality profiles of this group were different than we expected when we began the project. So they came from a variety of backgrounds. So, one had been an astronaut earlier in their careers, one was a widow, one had been an investor with no prior management experience, one inherited a family company, although publicly traded. But they shared an interesting set of characteristics. So all 8 were first-time CEOs. It's a very surprising finding. Half of them under 40, when they got the job, so they tended to be young. Only 2 had MBAs, but 4 had engineering degrees. Yeah.
How did the book come about in the first place?
Yeah, so as I mentioned earlier, my firm, I'm in the private equity business, and every other year we host a conference for our CEOs. So the current people who run our portfolio companies, the alumni, people who've run companies that we've exited from, and then CEOs who we're wooing, hopefully to work with in the future. And we bring them together in a resort somewhere in the western third of the country. That's where our portfolio, the United States, where our portfolio tends to skew. And we always have a headliner speaker. So we've had Jim Collins, who I mentioned before, Michael Lewis, Nate Silver, people like that come and speak. And then we have a few more practically oriented talks. And about a decade ago, I raised my hand and said that I would do one of those more practical talks, and I then had to figure out what I was going to talk about. And I'd heard about this 60s era CEO named Henry Singleton, who ran a conglomerate called Teledyne. And we had a Harvard Business School student working for us that summer between years at business school who was excellent between his first and his second year, and he had been a college tennis player. And I asked him if he wanted to work with me in his second year in an independent study for credit to do a deep dive on Singleton and Teledyne. And he said, I would love to do that project, but unfortunately I've just committed to another project. However, my doubles partner is looking for an independent project. So I called up his doubles partner, who was a guy named Aleem Chowdhury. And Aleem was a Phi Beta Kappa in physics from Stanford, where he played varsity tennis. So just a very talented guy. And he and I did a year-long project, a deep dive on Teledyne. First semester was an analytical deep dive, on all of the comparable companies in Teledyne, the financial data, deep analysis of that. In the second semester, we interviewed everyone alive who'd had anything to do with the company. And as I was writing that up, Aleem came to me and said, if you found that project interesting, I know a really smart guy in the class behind me who's looking for an independent study. So I got connected to that. So I just got very lucky. I got into this vein of, and it did sort of one a year, get into this talented vein of HBS second-year students.
Did they help you improve your tennis game as well?
I did play some tennis with them, and yes, there's several levels above my tennis, but it was fun.
Did your work at Housatonic influence the book? Has it changed, and I guess as a corollary to that question, has it changed the way Housatonic approaches investing opportunities?
Yep, so I would say that it has, the short answer to that is yes, and primarily that's in the form of strengthening some tendencies that we already had. So, we have always had, as a firm, a bias for backing talented younger CEOs. So we're generally not looking for the mid-50s executive who's done it, once or twice before. We're very comfortable backing earlier career CEOs who have a prior history of success, prior P&L experience, but they're getting their first opportunity to earn real equity. And the book, again, all the CEOs being first-time CEOs, sort of has borne that out. We also tend to own things for longer periods of time, and that's, again, these ideas really are most powerful over longer time periods. They're really sort of that set of capital allocation skills is really one way to think about it. It's sort of how to optimize the compounding in per share values. And then we also try to implement share repurchases in our own way. It's more complicated than the construct of private companies, but we found some techniques for doing that, so it's prodded us to do that.
You emphasized earlier capital allocation and cash flow as key indicators when examining a business, areas emphasized obviously by the CEOs you profiled. Perhaps you can expand on that a little bit more.
Yeah. So, I mentioned sort of the 3 sources and 5 uses, sort of the channels for capital allocation. As a group, these CEOs tended to pay lower dividends than their peer group, believing dividends to be relatively tax inefficient, as they're sort of taxed twice, once at the corporate level and again at the individual level. They tended to do very occasional large acquisitions. So after long periods of inactivity, they were comfortable making occasional large bets. They tended to, over time, repurchase significant percentages of their shares outstanding. They were comfortable using debt to varying degrees. They were very focused on minimizing taxes, which has a significant impact on long-term outcomes for shareholders. And they were very comfortable with highly decentralized organizational structures. So it was a very common trend across the group. And they were, well, we can talk about sort of their personal characteristics, but as a group, they were quite analytically oriented, and they tended to evolve sort of unique idiosyncratic metrics for thinking about their business.
It's interesting that you highlighted leaders who are in some cases frugal or who avoid the limelight, including media and Wall Street events. Do you have any sort of favorite stories that illustrate these traits?
Yep. So if I was going to describe them as a group, as personality type, it's interesting. You wouldn't use the traditional CEO adjectives of visionary, charismatic, and strategic. Instead, you'd use words like pragmatic, flexible, dispassionate, cool, analytical, frugal, as you said. So those are so some of the stories reinforce that. So there's one of the companies in the book is a company called Capital Cities, ABC, which was a very successful media company focused in the broadcast industry in the 1970s and 80s. And the guy who ran that company is a guy named Tom Murphy. And there's a great story from early in Murphy's career. He was hired to go run the first station that the company had purchased by the original entrepreneur. And the station was located in Albany, New York, in a dilapidated former convent. And the guy who hired Murphy said, listen, I'm going to send you to Albany. I'm going to leave you alone to build that business. And I just ask that you do whatever you can to get the business profitable as quickly as possible. That's the first thing. And once it's profitable, I'm going to give you, lots of autonomy. The only thing I'm going to ask you to do is I want you to paint that building, because it's just a wreck and it's not going to present a professional image to the advertisers. And Murphy's response was to paint the two sides facing the road. Right? So, and that's great. If you go into Tom Murphy is 91 now, and he still has an office in ABC's. Capital Cities ended up buying ABC in the 80s. If you go into the ABC headquarters building off of Lincoln Center, right around Lincoln Center in New York City, and you go into Tom Murphy's office, over his desk to this day is a picture of WTEN, Albany, New York, that original station.
That's great.
So that was a story. And then this idea of decentralized structures sort of was widespread across the group. But I have a personal story related to that. I grew up in the Boston area, and there's only one company in the book that was headquartered in the Boston area. It's a business called General Cinema. It was run by a very talented CEO named Dick Smith over a long period of time. And I went to the movies as a kid in a movie theater in a suburban strip mall outside of Boston, Chestnut Hill, Massachusetts. And I went to all, I'm in my age group, sort of the touchstone movies were, Jaws, Star Wars, The Shining. I saw all of those movies at this same movie theater. And every time I probably went to that movie theater 100 times. Every time I left the theater, there was a nondescript door just to the left of the theater entrance, which I assumed was the theater manager's office. But in fact, that door led to the corporate headquarters for General Cinema, which, in addition to owning a large chain of movie theaters, was the largest Pepsi bottler in the country, the largest educational publisher in the United States, and it owned a controlling interest in Neiman Marcus. Right? So this idea of small corporate teams, the opposite of sort of fancy new headquarters buildings, was a common theme in the book.
Well, Dick Smith's experience with General Cinema actually does touch a subject that's close to the hearts of many in this room, namely succession. Smith took a family-owned business, as I understand it, and ran it successfully for decades. You alluded to one of the secret sauces that made them successful. What else could you speak to that the Smiths got right, if you will?
Let's see. So the most interesting thing about the Dick Smith's tenure at General Cinema, which is he ran General Cinema for 43 years and had a 16% compound return over that period of time. Right. So if you had invested $10,000 with him, it was worth about $6.5 million at the time he exited. Right. So he had extraordinary returns over a long period of time, and really all of that can be attributed to 4 or 5 key decisions across 43 years. And so what Smith was really good at was being extremely patient. So he had this pattern of a long period of inactivity, followed by an occasional large acquisition. So he basically made one a decade. He bought the Pepsi bottling company I mentioned in the 1960s.
Yeah.
He made the retailing investment in the 70s and the educational investment in the late 80s. So long periods of time waiting for truly compelling opportunities, and then when you see them, being prepared to size those bets accordingly. It's probably the most distinctive. He's probably the best example of that in the whole book, actually.
Interesting. You say in the book that at the time of writing, no MBA program had much of a focus on capital allocation, interestingly enough. Is that changing at all? You also noted that few of the leaders had MBAs themselves. You talked about a number of engineers, for example. Is an MBA in some ways an inhibitor to being an iconoclastic CEO?
That's a good question. So I would say that that capital allocation, that framework I described earlier, the sort of three sources and 5 uses, is not the way finance is taught in business school. And by the way, I went to business school, and I'm a big proponent of the 2-year MBA program as a valuable career step in a business career. But the way finance is taught in business school doesn't get at the capital allocation question. It focuses on the sort of a general finance class in the core curriculum that often teaches modern portfolio theory, CAP-M sorts of concepts. And then there's sort of a general corporate finance class that gets into some of these topics, but it doesn't frame it in terms of the investor's perspective. So really the perspective that these 8 CEOs took was very similar to that of an investor. They would only do a stock repurchase when the returns from that repurchase were compelling relative to all other alternatives. They thought about their business and the ways that they invested the capital that the business produced, very much like a portfolio manager would in managing a mutual fund or a hedge fund. And that perspective is not the way that corporate finance is generally framed and taught, at least in U.S. business school programs.
You've been talking a lot about share buybacks, which is an issue that is kind of front and center today. And you talked about how these leaders were reluctant to pay dividends, generally speaking. Anything else you wanted to maybe expand on in that regard?
Well, so I think if you look at the way corporate America's in 2014 broke the record for most capital allocated to stock repurchases ever.
Yeah.
And it broke the prior record, which was 2007. The lowest period of capital allocated to repurchases was 2009. So corporate America's track record is almost perfectly contrary to what you'd expect to get good returns. In other words, they systematically buy high and effectively sell low.
Right.
And it relates to the way buybacks are typically implemented in U.S. companies and Canadian companies as well, where you have a board agrees on an authorization for a certain amount of capital to be deployed for buying back stock. Usually that's a small percentage of the market cap of the company, and then the capital is allocated in equal quarterly increments over time. And the increments are normally designed to offset option grants, so there's very little net shrink.
Yes.
And so not surprisingly, returns to corporate buybacks generally have been very mediocre. But that pattern is very different than the way the CEOs, these 8 CEOs implemented their buybacks, which was they waited, again, long periods of time, and when their stock was compellingly cheap and they thought the returns from purchasing it were compelling, they would buy large amounts of stock. So the pattern was, there's John Malone, who's one of the CEOs profiled in the book. There's a story about if you were an investor and you showed up to the 3rd quarter call in 2011, you were told that 11% of the shares had evaporated in the prior 90 days. The company had just implemented a buyback. They had the authorization in place, and they just bought in the shares when the stock was very cheap.
Yeah, that's good. Another characteristic these outsiders exhibited was a preference for decentralization, as you alluded to. Putting authority really in the hands of the operating managers. Why do the leaders, or these leaders that you profiled, why do they generally prefer this kind of approach?
Yeah, I think in all cases it related to a belief that decentralization avoided the creation of dense corporate hierarchies. It preserved sort of entrepreneurial energy. It also led to leaner organizations, by removing layers of cost. And it just generally, as one of the CEOs said, it cut down on rancor. It cut down on internal corporate politics, and it sort of created and self-selected for an entrepreneurial bias. And all of the companies that had these heavily decentralized structures had very, very powerful cultures.
Now, my next question might be a little bit difficult because these outsider CEOs, by definition, shun the spotlight. But I'm wondering if you had any thoughts on maybe who the next generation is, where are tomorrow's outsider CEOs?
Yeah. So I think there are some current companies that exemplify these same characteristics. So some examples would be there's a U.S. company called TransDigm in the specialized aviation components space that has done a remarkable job over a long period of time under a CEO named Nick Howley. The Rails brothers at Danaher, and interestingly, potentially now at Colfax, have been pursuing a similar approach over a long period of time. There's a home builder called NVR that has done a very good job along these lines.
Where are they based?
They're based in Florida. They're based in Florida, or they have operations in Florida. They're actually based in the Mid-Atlantic region. There's a company called Arch Reinsurance, and then there are a few Canadian companies that I think are very definitely following these principles. There's a software company called Constellation Software, which some of you may be familiar with, run by an excellent CEO named Mark Leonard. There's an insurance company called Fairfax Holdings that I'm sure many of you are familiar with, run by Prem Watsa. It's one of 3 or 4 sort of mini Berkshire-like companies. Brookfield, I think, has done a very good job of allocating capital over a long period of time. Controversially, I think the jury is very much still out on Valiant in this department. So it'll be very interesting to see how that plays out over the next year.
Absolutely. What lessons should people in this room take from your research in terms of allocation of their time and priorities? Is there a secret formula that can be replicated here?
So I think, if the objective is to recognize, great CEOs or, investment managers, I think as it relates to CEOs, I think there are 2 patterns that are interesting. So the first is you would expect that over time, capital allocation ability would trade at a premium. That would be logical. But in fact, if you look at these 8, for structural reasons that I'll get into in a minute, they often trade at discounts to their peers, despite excellent long-term records. And the reasons for that is that they have a focus, as I mentioned earlier, on minimizing taxes. That's kind of a core tenet of the group. And that focus often produces complexity, complex structures that are hard for analysts to understand. So you have complexity, you have use of leverage, occasional use of leverage, and then you have a general bias towards spending as little time as possible on investor relations. As a group, this group of CEOs did not feel that allocating significant time to interactions with the Wall Street community or the business press was a good use of time. Those 3 things in combination can occasionally produce dislocations in stock price. So even the best of the allocators occasionally trade at discounts. And that would be true as recently as the last 3 or 4 years for Warren Buffett at Berkshire Hathaway or John Malone. Some of who are the 2 of these CEOs who are still active, or John Malone at the Liberty entity. So that's one pattern. Second pattern is, trying to recognize, up and coming CEOs who have these characteristics. And I think, it's about 5 years or so before they have been in the seat long enough to have actions that you can judge them on. You can sort of view their investing decisions and allocation decisions and make a determination. Prior to that point, I think you can learn a lot from their vocabulary, from the way they talk about their businesses. And if they're using words like per share consecutively, if they're talking about the cash economics of their business, if they're talking consistently about returns from different investing activities, IRRs, all of that I think can be very revealing. So I think there are some markers, some signals earlier on in with new CEOs that can be predictive.
What's some of the language that you want to shy away from?
Yeah. So the most dangerous language is things blindly describing growth. can be very dangerous. So particularly growth at the top line, at the revenue line, without an accompanying idea of what that translates into in terms of cash profitability per share. The other thing is, I think the word strategic is often a flashing yellow light. I think a lot of things, a lot of business decisions, particularly acquisitions, are justified as being strategic, but a CEO ought to be able to describe in very precise terms why it's strategic and what that means in terms of the creation of value for shareholders per share over time. And if they aren't crisp, I'd say another characteristic is crispness. These CEOs tended to be able to describe what they were doing pretty succinctly. So a lot of verbiage, I think, is generally a contraindicator.
Yeah, I'd agree. For smaller companies, getting capital is the hard part. Not necessarily allocating, but actually getting the capital. Are there any lessons to be learned on that side of the ledger?
In terms of attracting capital?
Yeah.
Yeah, I think the message from this group would be that, so this is more in the context of a startup or growth equity kind of a setting.
Smaller business.
Yeah, so I think this group would generally have had a bias to becoming self-sustaining as quickly as possible. Right, so if they were faced with the choice of having to raise a lot of capital to continue a high trajectory growth curve, or growing at a slower rate in order to achieve profitability earlier and have options, control their destiny, they would choose the latter course.
Yes.
I think that would generally be their bias as a group. The reality is they were running later stage profitable businesses, so it's not a perfect analogy, but I think that would have been their bias.
Part of delegating day-to-day decision-making by the best CEOs, and you talked about decentralization, for example, is setting up the right incentive structures, compensation being a big issue today. As author of The Outsiders and as a private equity manager, how well of a job of aligning incentives do you think the private equity industry does, for example?
So I think the answer to that, I would say the generalization, Jay, and answer to that is I think they do a pretty good job overall. So not perfect, and it would vary a lot by situation and by firm, but the guiding principles in the world of private equity around compensation are that management teams are given the opportunity to earn significant personal net worth through equity ownership in the business, with the amount of that ownership tied to outcomes for investors. Mm-hmm. It's a totally different dynamic in many ways as it relates to some of these capital allocation topics, because in private equity, of course, the investors control the company. So ultimately, they control those capital allocation levers, both the sources and the uses. But the general model there is low current compensation, and an emphasis on long-term equity-like building of net worth. And I think generally that works pretty well. I think if you look at it's different in many cases than public market models.
Absolutely. Yeah. Katharine Graham I found to be a really interesting profile. She's arguably the most impressive profile in this book. She inherited the Washington Post with practically no business experience after her husband died suddenly. She led her company to be tremendously successful in providing value to society and investor returns, particularly for many of the women in this room who are taking an increasingly strong leadership role in managing their family's business and wealth. What takeaways do you think stand out from Graham's life?
Yeah, so Katharine Graham's life is remarkable, and she wrote a very Pulitzer Prize-winning autobiography that's worth reading for anyone who's not read it. But as you said, Jay, so her husband, Phil, built up the Washington Post company. Yeah. And then he was a manic depressive who committed suicide, tragically and very suddenly. And so Katharine Graham found herself in her late 40s as the only female CEO of a Fortune 500 sized company in the United States, and she hadn't worked in almost 20 years. She'd been home raising their children, right? So she had this sort of extreme, sudden exposure to a top executive role. And over the period from the time she took the company public in the early 70s until she stepped down in the early 90s, 22 years, she generated a 22% compound return for her shareholders. massively better than any of her peers. She was far and away the best CEO in that industry in the country. And she made a handful, again, of really key decisions. So she took some time at the beginning to learn the business.
Yeah.
And then she made 2 significant personnel-related decisions that required great courage. So the first is she replaced the editor-in-chief of the Washington Post, a guy who'd been in that seat for 20 years, with a young, unproven editor named Ben Bradley, who ended up being a wildly successful editor-in-chief, won 18 Pulitzer Prizes and so forth, but a very controversial decision. Secondly, during the extreme downturn in the 1974-75 period, an investor accumulated a big chunk of her stock, and a guy named Warren Buffett, who at that point in time was entirely unknown. And so her board was very nervous that this unknown outsider was making a run on the company, and she flew out to see him, sat down with him, and very quickly realized that he was actually a uniquely talented guy and she decided at that moment that she wanted him to be her key business advisor. So against the advice of her board, who were strongly opposed to it, she invited him onto the board, and he became a key influence going forward. So she made some courageous early decisions in the personnel area that were important, and then she made some capital allocation decisions that were very contrarian at the points in time she made them.
One of the things that I've observed with the most successful leaders is there's an element of intangibles, an element of instinct that can't necessarily be taught, and I see some of that sort of permeating through not only analytics, but to take it to another level, just having those right intuitive abilities. Anything surprise you about Warren Buffett as you delved a little bit into him from a profile point of view?
That's a good question. So you mean, his story and his record are just remarkable, and so it is fascinating to. Surprising. I've got to think about that for a minute. I guess that the consistency over a long period of time of the core is almost in addition to being an exceptional investor, Buffett is also almost a philosopher. There's sort of a broader worldview that has informed his whole business career, and that relates to investing, but also to the way he very consciously designed the company. And that worldview was in place very early on. So you can go back. The Berkshire shareholder letters are remarkable. I'm sure, many of you, maybe all of you, have read at least some of them. But before Buffett ran Berkshire, he ran an investment partnership out of his bedroom in Omaha, and he did the same. He did an annual letter, for the 13 years he ran that partnership. And the philosophy is intact in those letters. You can see sort of the pieces of it kind of assembling over time, but it's just so the power of that it's fascinating to see how that's evolved over time, but how the core tenets have remained very similar. Yeah.
Something I notice, I obviously don't know Warren Buffett personally, but what I've observed with some of the most successful leaders is the element of humility. Yep. Because if you don't have that humility, your judgment can be clouded by, as I mentioned earlier, tailwinds or the fact that your team may have helped you, but not acknowledging that, and over time, that ego can really be damaging. So that's another thing that I noticed permeates, at least from an underlying point of view, a lot of the leaders that you've profiled.
Yep, that's one of the central, again, sort of in the personal characteristics category. Humility was, and humility in the form of, an aversion to PR and investor relations, and being sort of out promoting the company, and then, but also in terms of how the CEOs interacted with their teams. Just the whole idea of decentralization is fundamentally humble, right? It's the idea that corporate headquarters does not have all the answers. We're going to architect this organization in a way that the power and the autonomy resides with the local business unit managers.
That's a good
And we're
point.
going to leave them alone, so.
Yeah, that's good. The outsiders exhibited, and of course Buffett's a great example of that, an uncanny ability to value assets, whether it was for acquisitions or share repurchases. Are there rules of thumb for private investors that they can use to determine where there's value in the market?
Let's see. Wow, that's a broad question. I think there are rules of thumb, but they tend to correlate with different industries. So I think different industries apply, different rules of thumb apply, and different heuristics apply in different industries.
Right.
I think the overall guiding principle for this group was that they, as CEOs, they did the analytical work themselves. So they did not delegate it to internal finance teams or to investment bankers or external consultants. They themselves were involved in doing the actual analytical work, and they all had hard hurdle rates. So it sounds very simple. It's very powerful to have an internal, clear, minimum threshold return that any project must clear. And if they didn't have projects that could clear that hurdle, they held onto the capital. They didn't allocate it. They let the cash balance build. And so I think that the discipline of that is very, very powerful. It's very powerful. So I think in any industry, setting the hurdle rate is critically important, and then being consistent in how you apply that. Insisting on conservative assumptions in the models that are built.
Yeah, makes sense. Are you working on anything specific at the moment? Perhaps a sequel or another book on a different topic?
No.
You're done.
No, I've done a few. I've done a few articles on unrelated topics, and there's some other things I might write about. But I will not do a sequel to the book. I may add one chapter on an international CEO. So that's the one thing that's in process. Yeah.
Good. We have a few minutes, and I'm sure Will has prompted a good deal of thought. Are there any questions from the audience? Go ahead.
Yeah, sure. Okay. So, people in the book you're talking about, the CEOs, a lot of them mentioned introversion, mentioned trying away from the limelight. The flip side of that.
Can you hear me better now? Yeah. Okay.
Yeah.
Thank you. So I'll just repeat the beginning. A lot of the traits that you mentioned among the best CEOs had to do with introversion, avoiding the limelight. It's possible that if a lot of them weren't brought into the companies at an early stage, they might not have been actually promoted, because people who get passed over a lot of time are the introverted people, right? So I'm wondering if you can offer some advice, whether it's for capital allocation or for managing companies, how to avoid passing over potentially spectacular people who are introverted or who are difficult to spot. So, thank you.
Yep, that's good. That's a very good question. So I would say I don't want to overstate the introversion. So as a group, they were not actively promotional. And again, I'm sort of generalizing across a group of 8, so there'd be a range of personality types within that. But they were generally more introverted than the norm for CEOs. And I think a number of them were promoted from within, or came from outside, but weren't founding members of management teams. So they were brought in by virtue. So I think it's focusing intently on the record. If you and not being as focused on personal presence in a short interview. It's having a process, and I'm sure your process is it has depth of 360 review of every post, every step along the way, and the related record, and being as objective, almost quantitative as possible in assessing results, and then having those broader conversations. I mean, these people, although they were introverted, they tended to create very powerful cultures. They had very high retention rates of key people. They created very strong work environments, and that was present in their teams in the jobs they had before. They just were, they were not Trump-like in their external, their desire to be in the headlines. I don't think they would have been active users of Twitter, generally, as a group.
Any other questions?
Yes, in private equity, you say you're a long-term player. What triggers your motives to exit your investment, and how do you do it in a private field?
Yeah, so I don't know if the question was how do we think about in private equity, exiting, given that we have a bias for longer hold periods, is what are the triggers for our exit? Is that right? So the way we think about it is we, once a year, do review every company in our portfolio in detail, and we will reproject the next 3 to 5 years based on the reality today. And we'll then assess what we think the return is from holding it under a range of exit scenarios. And we'll compare that to our original underwriting case and to sort of the broader environment. And every now and then, when we see an anomaly, so a company that, for instance, you might look at, we run our projections, and then we have management's projections, which are always more optimistic than ours. And every now and then, you'll see a company that even in the management projections, the value 2 or 3 years out is the same or lower than the value we think we could sell it at today. And when that happens, that's a strong signal that it might be prudent to explore an exit. The actual exit decision, we almost always control that. Since we're typically the control shareholder, or we, in conjunction with other shareholders, are the control shareholder. So it's those sorts of anomalies that tend to drive us to the market. And honestly, in the last 24 months, we've seen more of those than ever before. The current market is really pretty frothy, at least in the US in private equity. And so doing that math, it's gotten harder to calculate interesting incremental returns from today's values. Yep.
Looks like we might have room for one more question, if there's anyone out there who has.
Talking about management's projections or the markets must be yours, do you think they're going to apply to your 8 highly successful businesses?
It's a great question. So I don't know if everyone could hear that, but the question was, I mentioned just now that we tend to discount management's projections in our own base case forecasts for these portfolio reviews. And the question was, would that have been true for the 8 CEOs in the book? And the answer would be no. No, this group, they really were very, very focused on truly conservative projections and on equivalent guidance for investors. So when they did actually give guidance to investors, it was conservative. And in doing the work on the book, we actually went back and had detailed information on quarter-by-quarter guidance across these companies and estimates. And this consistent pattern of sort of under-promising, over-delivering quarter after quarter after quarter was very typical. So that was really a core sort of tenet across that group. It's a good question.
Well, please join me in thanking Will Thorndike for sharing his insights, and certainly found it very fascinating.